It was a quick zip, and then it's relatively orderly in the way that it has continued to trade onwards from there. Then the data hits, and the market immediately volatility stops. That's the difference that sensitivity makes for you. It means that you do have to get much faster and much more aggressive on the ladder. What sensitivity is all about is, well, how much or how quickly and how big are the reactions? Now, there's two types really of theme. There's one which is an economic theme. This is something that will generally grow. The reactions and the importance of a certain piece of data, inflation, over the last couple of years gets bigger and bigger and bigger and bigger. It grows, it sustains for a while, and then it falls back. On the other side of that is geopolitical shock, if you will. When you have geopolitical shocks and geopolitical themes, generally market sensitivity and opportunity size goes up very, very, very fast. You have to be very aware and very quick to change into this is the key thing at the moment. And as soon as you've got that, then there are your opportunities, but they will disappear quickly. So understanding where you are and what the theme is dictates the necessity to be more and more aggressive. Whereas with an economic theme, generally you will have a sort of growth phase of reaction and a greater sensitivity over time. So that helps you as well understand where you are with your theme, where you are with market's reaction to a theme. So let's go and have a look at sensitivity. I'll try and illustrate this for you with a couple of price adders and a couple of charts. On the inflation theme, we know that inflation was picking up rapidly during July 2022. We know that the Fed was raising rates significantly during during 2022. So what then starts to happen is the reaction to inflation gets bigger and bigger and bigger. What I've got here then is CPI data from July 2022 and July 2023, the expected number and then the actual number. Now, both of them are 0.2 out. So what this is showing you is theoretically, they should give a similar type of reaction, 0.2 higher, 0.2 lower. However, you look at the size of the reaction. July 2022 on the right, you get an 80-point move in the S&P. That's 80 full ticks in the S&P in 1 minute, and then 110 over the course of an hour. July 2023, you get 20 and 33 over the course of an hour. So let's get a little ladder up and I'll show you exactly what I mean. First up, July 2023. Now, what I have done with the S&P is I have compressed it. So what this means is it only shows the full ticks. It doesn't show quarters. It only shows full points here, so that this is a little bit easier to read as the move happens. There's the data, July 2023. So that instant move in the S&P was about 10 points. And then we start to continue onwards. But note how relatively orderly this is. It was a quick zip, and then it's relatively orderly in the way that it has continued to trade onwards from there. So nothing overly surprising. This is then the beginning of this move here. We move from the mid 80s up towards the mid 90s, and then we're going to continue onwards. It's around about 20 points up by this point. That's about the first minute of trading. So you see that relatively orderly trade there. And realistically, when the theme starts to become less sensitive, you actually get less opportunity to take a trade on here, because even if you bought it on that first little skip, it only gives you probably about another 5 points on the back of that. So your opportunities become a little bit more limited by the sensitivity. Don't get me wrong, there's still opportunities, but you have to factor this in. Go and look at July 2022 and you get something very, very different. So again, tick compressed, it's only showing the full points. This is not even on the data. This is just pre-data, a stop hunt on low liquidity. 30 ticks, 30 big ticks, 30 points up. Then the data hits and the market immediately volatility stops. So the data hits, we're now trading down around about 50 points here. And the thing with high volatility, theme sensitivity, this has just dropped down 50 points on a volatility stop, i.e. you're not allowed to trade because the market has got so volatile, so the exchange shuts. And yet you could still sell immediately and take another 20 points out of it almost instantly. That's the difference that sensitivity makes for you. It means that you do have to get much faster and much more aggressive on the ladder, but understanding the implications of these types of events, the little opportunities to scalp 10 points in the S&P in a matter of seconds, that's what volatility and sensitivity gives you. It's something that we spend a lot of time trying to teach people by giving them drills on stuff like this, getting them to go and trade previous pieces of data that exhibited very high sensitivity and volatility, so that when these things come around again, you're able to transact in those environments. You're able to deal with that sudden sort of speed shift and scale of movement.